go from, this is not a typo, 10 cents to $60. I yeah, it's a big number. I I think gold did exactly what it was intended to do. In US dollar terms over the course of the year, it lost 2% of its value. Compared as an example to a collection of world-beating tech companies that lost 50 or 60% of their value, or the S&P 500, which lost 16 or 17% of its value. There's a whole bunch of things around fossil fuels that most investors, at least the ones who read the Wall Street Journal and CNBC and, you know, the popular media, just don't understand.
How would you like to make almost 60,000% on a silver equity stock? Sounds impossible, right? Well, according to today's legendary commodities investor, it did actually happen within his career. Could it happen again? I will actually leave him to tell you all about that. Today, I speak with the incredible Rick Rule, where we talk about why gold's best days are ahead of it, why fossil fuel companies may be your best investment strategy for the year, and why you should stop listening to narrative over arithmetic when it comes to silver. And welcome back to Rock Solid Investing. I am your host, Shay Russell, and joining me again today is the fabulous Rick Rule, who I'm sure is cringing at the mere idea of me introducing him as that. Rick Rule is a private investor and speculator. Rick, how are you today?
Life has been very kind, Shay, and I trust to you. Thank you for having me back.
It is wonderful that once again we can cross the planet and have these conversations. Now, Rick, I haven't seen you in 6 months since I was last in Fort Lauderdale, not Miami, as I keep telling everybody. So there is much to catch up on since we have last spoken. Now, first and foremost, I'm going to start off with a question about gold because I am a gold analyst at heart and I will never let that topic go in a conversation with you. Now, let's be honest. Gold had a pretty sucky year last year. It actually traded for 7 consecutive months down. Now, that's actually never happened since gold's been freely floated. Now, given that gold got pretty close to scraping 1630 or 1,630 US dollars per ounce, it's now rallied back up to nearly $1,900 per ounce at the time of having this conversation. Now, the problem is when gold tanked last year, so did miners. Now, what I want to know is, were gold miners going cheap back then when the gold price was falling? And now that the gold price is rising, are suddenly gold miners going to become too expensive?
Well, that's an amazing question. And I'll try and deal with all of it, perhaps in sequence. The first thing you said was that from investors' point of view, gold underperformed last year. I think gold did exactly what it was intended to do. In US dollar terms over the course of the year, it lost 2% of its value. Compared as an example to a collection of world-beating tech companies that lost 50 or 60% of their value, or the S&P 500, which lost 16 or 17% of its value, or the US 30-year Treasury, which on a capitalized basis lost 30% of its value. If you own gold, Shay, the way that you and I have talked about in various interviews for the last 5 years, which is to say, as portfolio insurance, I would suggest that gold did a fine job indeed. I would even argue that for people like myself who are looking to increase both their wealth and insurance, that gold was more attractive to me at $1,700 than it is at $1,900 for the simple reason that it was then $200 cheaper, and I'd like to buy more. I realize that many people don't have the same sort of emotional or financial grounding in gold than I do. But I always like it when asset classes that I'm desirous of owning more of are cheap. I don't think that gold is expensive at $1,900. I don't think that gold stocks were expensive at $1,700. And I don't think they're expensive at $1,900. I would argue, as an example, that gold stocks, measured by the metric that I like to use, which is to say the net present value of cash flows on existing reserves and resources relative to the enterprise value, are as cheap as I have seen them in a 45-year career in the gold stock. In the gold stock market. Remember that as the gold price goes up, the at least pro forma free cash flow of the gold producers goes up. So although the gold shares have rallied mightily in the last 2 or 3 months, the net future values of free cash flows have increased with the gold price too. So with regards to all of the questions, I suspect that gold's performance didn't disappoint me. It might have disappointed people who are in gold for reasons, well, for speculative reasons. I mean, I realize there's a whole bunch of people there who hear the gold narrative and have visions of $10,000 to $12,000 in their head and are disappointed that it hasn't happened over a long weekend. But those people can't be helped, irrespective of which investment category they choose to pollute. They can't be helped. For people who have an orientation towards gold for what it is good for, which is to say insurance during very, very, very hard times, or for people who own gold stocks as a way to enjoy increasing free cash flows around the gold price, both of which are attractive. I'm beginning to think, Shay, that we will see a circumstance in 2023 that's similar to the circumstance that we saw in 2020, which is to say a gold stock market that is beginning to be driven by the beginnings of merger and acquisition activities too. Call that icing on the cake, if you will. But we're seeing real increasing rumblings around amalgamation.
Actually, Rick, you've just reminded me of something I read this morning with that answer that you've given. And it was a comment from let me just quickly flick to the webpage here, the CEO of Barrick Gold. Now, there was an article written in the news this morning, and he's basically talking about how the mining sector is facing one of its most challenging conditions it's ever seen. Now, the reason why I'm putting this question to you now is this isn't your first rodeo. You've seen challenging market conditions in your vast experience. I don't have the CEO's quote exactly on hand, but tell me, do you honestly, do you agree with the premise that yes, the mining sector is facing its most challenging conditions it's ever seen?
It depends on how you describe challenging. From Bristow's viewpoint, and by the way, I'm a huge Mark Bristow fan. I've known him really since his start, at least once he came out of academia. His corporate start in South Africa. Understand that Mark has to replace 5.5 million ounces of production every year. That's a mighty challenge. The industry, I guess, has several challenges. The first is that the industry has underinvested in every aspect. It's underinvested in exploration. It's underinvested in development. It's underinvested in sustaining capital costs. And all those chickens are coming home to roost. If in a capital-intensive business, if you don't apply capital, you don't have a business. So the industry has to face that. Bristow has, in fact, invested. Bristow has a larger challenge than most because he's been more successful than most over the last 30 years. Most people who've been involved in the last 30 years don't have production to replace because they didn't manage to generate any production over 30 years, where Bristow managed to generate a lot. The industry has other challenges too, Shay, that you and I have talked about. And that is the fact that the junior part of the industry, if you look at the length and breadth of it, is insolvent. If you have 1,500 listed juniors, we've talked about this before, probably only 200 are viable. The truth is that if you put the whole junior sector together around the world, every junior mining company, you called it Junior Explorco, you merged the whole disgusting lot of them, that business would lose $2 billion in a good year and $6 billion in a bad year. So what is the junior industry worth? Is it worth 6 times losses? Is it worth 12 times losses? In a bull market, is it worth 15 times losses? What's the appropriate price-loss ratio? Now, the way that an individual investor looks at that, of course, is to understand that 10% of the issuers in the sector generate so much performance, such insane performance, that they add legitimacy and occasionally luster to a sector that costs the investment community between $2 and $6 billion a year. The point of all of that is that for 3 decades, some of the underinvestment in gold and silver lies at the fault of the investors who misapply between $2 and $6 billion a year in the pursuit of insane juniors, the sort of amalgamated aardvarks, you know, these nothing, nowhere penny dreadfuls that spend 60% of capital raised on general administrative expenditures. Bristow has a genius for going where other people don't and doing what other people don't. Bristow is willing to go to countries that most people can't pronounce. When he gets there, he doesn't fly white people 9,000 miles to operate the mines. He uses locals who would like to be there and are happy to have the jobs. When mergers and acquisitions are out of favor, he buys things. When they're in favor and the prices are expensive, he goes on strike. If more of the industry was like Bristow, the industry would be a much better place to invest.
All right, there's no smooth gear change for where I'm going to next. I want to talk about fossil fuels. Now, this is, yeah, I told you, no smooth gear change. You went from second to fourth. So basically, look, nobody likes to talk about fossil fuels. We're meant to be a world moving away from fossil fuels. The problem is the world runs on fossil fuels. And if anybody has ever researched energy transitions, they don't happen in a decade. They take centuries. Now, fossil fuels had one of their greatest years on record last year. And obviously the Russian invasion was largely behind that. But also too, gas prices were creeping up ahead of the Russian invasion as well over in Europe. What I want to know is, given that there is no end to demand for fossil fuels, can we see hydrocarbons repeat the performance again this year in 2023?
I don't know about repeat the performance, Shay, but hydrocarbon producer prices are cheap, despite the fact that the stocks have rallied substantially. Remember that from the depths of the COVID-related transportation shutdown, the oil price has rallied from sub-zero, actually, but let's call it US $20 to US $75. The companies generate a lot more free cash flow at 75 than they did at 20. There's a whole bunch of things around fossil fuels that most investors, at least the ones who read the Wall Street Journal and CNBC and, the popular media, just don't understand. The first is that the world now in the last 30 years has spent something like $4.6 trillion on alternative energies, biomass, wind, solar, stuff like that. And with a $4.6 trillion expenditure, they have reduced the market share of fossil fuels from 82% to 81%. $4.6 trillion has led to a 1% decline in the market share of fossil fuels. You know now, of course, that we've replaced coal in the energy mix around the world, except that the leading year for coal demand in recorded history was 2022. And to suggest that the Russian invasion of Ukraine was responsible for all of the rise in hydrocarbon prices, I think diverts the blame. I think the blame is more Merkel than Putin. Angela Merkel made a strategic decision, of course, to focus on Russian gas, to the exclusion, as an example, of shale basins in the north of a place called Germany, which might be more inclined to have German interests at heart. In addition, she and her ilk decided to rely on solar, way far up in the northern hemisphere where the sun doesn't shine. One needs to ponder on the efficacy of policy decisions when one looks at energy prices. The big thinkers of the world are suggesting that peak oil demand has occurred. I believe that peak oil demand will occur about 2045. And I believe that there will be that's peak oil demand. It doesn't mean that oil demand ends at 45. That's the year that oil demand will stop rising. I suspect that we'll have another 60 or 70 years of conventional energy production. And if we enjoy 60 or 70 years at product prices on an inflation adjusted basis, the way that we see them today, the oil and gas stocks are cheap. But they're cheaper yet because the politicians are, because of their incompetence, conspiring to assist the business. Let me explain this to you. They are decapitalizing the business. They're doing their best to keep big pension funds, big institutions from investing in oil and gas. They are telling oil and gas producers that they're going to be the owners of stranded assets. So at the same time that the big thinkers in the EU and Biden and Trudeau are telling the energy industry, you must produce more to bring down gasoline prices, they're saying we're going to put you out of business in 2030. Now, your readers need to ask themselves, your listeners need to ask themselves, Shay, how aggressive they would be in spending tens of billions of dollars to have the industry that they were spending tens of billions of dollars on go away in 7 years. The governments are constraining sustaining capital investments, which at the same time is constraining supplies, which at the same time is keeping prices higher. The margins that the industry enjoys are at almost record highs. And most of the industry is decapitalizing. Most of the industry is sending back that money to its owners, which one might expect when they're ordered to liquidate. The better players in the business, the Exxon Mobils of the world as an example, are both maintaining sustaining capital investments, investing enough money that they can maintain production, and doing share buybacks and increasing the dividends. It's difficult to see a better circumstance for conventional fossil fuels than the one that we exist in today. I need to say that if you are one who believes in an impending recession, I think it's a probability rather than a certainty. It is easy to see a circumstance where supply is constrained but demand is constrained too, and we go through a period of softer energy prices. But looking at the longer term, these stocks feel extremely, extremely cheap to me.
All right. Well, speaking of silly government initiatives, I want to talk about the US Inflation Reduction Act. Now, I was fortunate enough to not be in the country when that came out, so I can be critical of it. Tell me, how on earth does something that has very aggressive policies regarding energy vehicles, insisting that it comes from local supply chains within the next couple of years, how does throwing a few $100 billion at a problem actually reduce the end cost for the consumer? But more importantly, how does something with such tight timelines actually rehome the manufacturing sector in the US? I don't see how it's going to do what Biden thinks it's going to do.
Well, I would suggest that you are an accomplished political analyst.
Flattery
I
will
would
get you
say
everywhere.
I would say that one of the few things that the United States still excels at is branding, which is marketing speak for bullshit. The Inflation Reduction Act was a pretty title around something that should have probably been called the Inflation Exacerbation Act. If you take the Inflation Exacerbation Act and then you marry it with the 2023 budget, which is the most ungodly spending bill I have ever seen in 50 years of being horrified at my government's expenditures, uh, you have well, let's just say if I was looking at it from the outside, I would just laugh. Sadly, of course, I am what they would call a citizen, and I call chattel. I'm one of the intended victims of the Inflation Exacerbation Act and the 2023 budget. I think around the world, people need to be concerned about this because the United States continues to drive the world's economy. The United States is still the world's mouth. We provide 23% of world GDP. And when you have a budget like the United States budget, which forecasts a $2 trillion deficit. May it only be that small. While continuing to increase off balance sheet and on balance sheet liabilities that already exceed, including off balance sheet liabilities, $120 trillion. The entire world, not just the United States, has reason to be concerned. Uh, it's not my want, but I think I actually understate the problem. I try to do it with arithmetic rather than adjectives. But the truth is that if you purport that you're going to control inflation with on balance sheet and off balance sheet liabilities exceeding $120 trillion and a $2 trillion deficit, you are, I guess you're misleading dumb people. And I guess you're ignoring people who can do arithmetic. Sadly, I guess those are two disproportionate populations. But it actually is serious. It probably probably isn't serious until it is. But it's very difficult for me to see how you reconcile that contradiction, Shay. I don't see them having the ability to borrow all of the deficit at interest rate levels that exist today, which is to say, if you are running 7 or 8% CPI stated inflation and you're paying 4% on a treasury, what you're saying to the lender is you should be willing to accept a 3% compound annual negative real rate of return on your lending. From my point of view, no thank you. I get that arithmetic. So if you run a $2 trillion deficit, and by the way, the deficit will be higher because the $2 trillion deficit uses last year's interest rate as the implied interest rate on this year's debt. It would seem to me that the only way that you deal with that is that you print. And if you make more of something, you certainly don't increase its value. I guess you understand in a very full sense what I think of the Inflation Reduction Act.
That was a fantastic answer, and it was better than I could have actually hoped for. Also, too, it's always fun to comment on another country's politics when it's not your own problem. Down here in Australia, we've got plenty of our own problems, I can assure you. We can save
That's so true. When you look at another country's troubles, they become comical because you don't think that you bear any responsibility for it. My friend Bill Bonner says he always likes to think about American politics when he's in Argentina or Ireland because he doesn't feel American then and he feels less responsible for his own conundrum. And I certainly agree with that. I've made it a point not to criticize countries where I'm not a direct or an indirect taxpayer. Sadly, because I've been an investor for many years, that leaves me lots of targets of opportunity.
I like the caveat. Now, let's bring this back to an investor case. I've got two questions for you to round out today. Now, first of all, I want to take this back to when we were last in Fort Lauderdale, not Miami, as I keep telling everybody. When we were in Fort Lauderdale together, and I was blessed by watching the fantastic Robert Friedland speak. Now, this is your conference, and I'm not meant to gush about how fantastic he is to watch, but he's
You are.
Yeah, I was gushing. He's entertaining and informative, and he's an absolute not miss at your conferences. However, he brought up the a sort of what seemed like an obscure issue to investors, and I want to talk about a little bit about how these matter when you're building an investment case for investing in mining. But he touched on dry stacked tailings and why this is information investors should know about. But tell me, why would he bring this up as part of really something that increases the cost for shareholders and mining companies?
Well, I think what he talks about, which is to say that the mining industry needs to pay increasing attention to the real and potential environmental liabilities that they're responsible for. As the world goes to more and more mining, and as more and more mining takes place in societies that perhaps don't have the capacity or the will to regulate it well, there are a variety of issues. The tailings dam failure, the catastrophic tailings dam failure in Brazil would be an example. There have been wonderful advances in tailing technologies, but they're expensive. One of them is to reduce the water balance in tailings, which is to say dry stack tailings, to move the tailings in place with much less water and reduce the probability of collapse. Now, it's also fair to note that Robert makes this point from the point of view of somebody who is mining very high grade copper and won't generate very much by way of tailings. But nonetheless, what Robert talks about is a real issue. And I think that investors need to consider in themselves some of the big issues that face the mining industry, which is to say, real environmental considerations. What do you do as an industry to prevent the distribution of deleterious materials, water and dust as an example, from mining operations? How do you ensure the stability of things like tailings and things like mine wastewater for decades after the closure of the mine? How do you continue the admirable job that the industry has done at making mining a safer profession? How do we bring more people back out of those holes in the ground alive and uninjured? How do we involve more local people in mining, particularly in emerging and frontier markets? How do we deal with the increasing demand for social rents that always accompany increases in commodity prices? Too many investors, when they look at the mining business, focus their entire attention on dividend yield and commodity prices. And sadly, a cursory look at an industry, a narrative look, an emotional look, is a wonderful way to lose money. Investors need to look for opportunity where other people don't see it, and they need to look at the very fullness of risks around mining. In blatant self-promotion, at Rule Investment Media, if you go there, you can see something called the Mining Investment Classroom. Albert Liu and I are doing a 32-part series on the consideration that investors need to put into various aspects of investing in natural resources and mining. This is not, by the way, information light. This will require people to do some work, but the price is right. It's absolutely free. And we talk about these, what we refer to as unexploded bombs, things that people should look at when considering investments in extractive industries. So thank you for the opportunity for an unabashed commercial.
I had no idea that question was even going to take us there, but joke's on you, because I said I had one more question left. Because you've given me that fabulous answer, I'm going to follow up. I've got a follow-up question for you. What you've talked about there is a great line, actually, bringing more people back out of the ground alive, because it's something that's not talked about in the mining industry a lot. It's sort of like 15,000 people a year die in mining-related accidents worldwide. It's a huge number, and this isn't to talk about the high suicide rate attached with mining in Western countries as well. Look, this is a little bit macabre, but I am getting somewhere. I was recently, at the end of last year, I was at a gold industry conference that talked about what the industry needed to do to attract more Gen Zs to the sector. Because at the end of the day, Gen Zs are going to be the next people taking over mining, and you would know this quite well. There is a lot of this generation that is not interested in mining. They're not impressed with extractive industries. Now, granted, recycling and technology of above-ground resources has a long way to come, and trillions of dollars in investment won't even change it just yet. But how do you highlight the great miners, and you know a lot of these people personally, how do you highlight the great miners, the great industry leaders, and the great companies that are doing this environmental work and putting social I've lost the word here, social issues at the forefront of what they're doing? And how do you get Gen Zs to see that change is being made?
I think that's happening right now, actually. I think it needs to happen faster. I point as an example to my friend Bob Quartermain when he built Pretium Resources. The first thing Bob did was recognize that in northwestern British Columbia, in a remote location, that flying a bunch of white people from Vancouver up to northern BC was inefficient when there were a whole bunch of native people who were unemployed who lived in the region and wanted to work there. It was a training challenge. You took a population base that hadn't had industrial employment before and turned them into mine workers. And you had to teach them not to mine in the old fashioned way, which is to say pick and shovels, but rather to operate remote trams, remote drills. But it worked. The labor force at the Pretium mine is probably now 40% native, 40% first generation industrial workers. Happy to be there. You don't have to fly them in, you don't have to fly them out. There's lots and lots and lots of women in that workforce. I know you're not supposed to say that there are differences, but there are differences. As an example, in a prior incarnation, Bob Quartermain learned when dealing with Andina populations in the northern Andes, you're going to love this, Shay. You're probably going to cut me off. But women have some sense of doing what they're asked to do. So in driving haul pack, big trucks, it turns out that these tires are worth $24,000 each. And tire wear is an important cost consideration. If one drives these trucks at sort of 14 kilometers per hour, one maximizes tire wear. The men, irrespective of how fast they were told to drive, drove as fast as they wanted to. And the women, it turned out, drove at the speeds that they were asked, prolonging engine life, minimizing wear and tear on equipment, minimizing wear and tear on tires. The consequence of that is that Quartermain figured out that if you're going to employ somebody to drive haul pack trucks, you ought, in fact, to employ women. All of which goes to say there is a generation of miners now that is willing to spend the money on training. It is training, first of all, that substitutes capital for labor and puts equipment in the way of rock falls, puts equipment in the way of explosions, puts equipment in the way of gas poisoning. So to the extent that more mining can be done mechanically, to the extent that people can employ capital rather than picks and shovels, the industry becomes much, much safer. It used to be, when I was coming up in the business, that everybody above a mucker looked just like me. Big, old, fat, either bald or blonde white guys. Irrespective of whether they were in northern Canada or in the high Andes in Chile or in Congo. Mercifully, now all kinds of people work in mining. You know, if you go to the Barrick operations that Bristow operates in the Ivory Coast, it isn't just the miners who are Ivorian. The people who run the mines, the accountants, the geologists, the engineers, are locals. That's wonderful. They want to be there. And mining in a country like the Ivory Coast or Guinea is a high status job. There are all kinds of wonderful people there whose lives are constrained because of a lack of opportunity. Mining provides the opportunity. Using an underutilized person where they'd like to be is really where we all need to be. And the problem in the West is bigger than just mining. Shay, Mike Rowe, who did the PBS series on dirty jobs in the United States, points out that there are 7 million jobs unclaimed in the United States that can provide middle-class living. They are jobs in factories. They're jobs being plumbers. They're jobs in heating and air conditioning. 7 million trade jobs that provide middle-class livings are going unclaimed, while young kids are going $150,000 in debt to get college educations that equip them to do nothing. So partially, I think that young people themselves will understand that so-called status is no substitute for money. And they will begin to quit aspiring to becoming professors of basket weaving and live in their parents' basement for the rest of time, in favor of operating around what are really generally pretty nice people in businesses like mining and oil and gas, and yes, plumbing. I, I'm I think it's a non-problem, Shay. I think it's a problem for 10 years. But if people recognize that they need to be self-serving, I think most people over time, irrespective of age, gender, or race, are going to choose a nice life as opposed to a lousy life. So I think it'll sort itself out over time. It'll just be messy between now and then.
Interesting. Okay, I like your perspective on that. Before we move to my final question, I loathe to comment on the difference between genders. I do. I hate getting into these. However, there is a bit of folklore. I was up visiting Mount Isa, which is a base metals mine in the
Yeah,
top
I
northern
know.
part of Australia. I'm sure you know where it is.
Mm-hmm.
And there was, at the peak of the Australian mining boom, there were stories going around that the miners were supposedly going to local supermarkets and tapping the checkout chicks on the shoulder, or that's what we call our supermarket service here in Australia.
Yes.
Checkout chicks,
Uh-huh.
supposedly saying, "Hey, you're earning $40,000 a year here. Come earn $100,000 a year driving
Yep.
trucks in the mine."
Yep.
Um, Clearly, it was an international discovery.
Correct. I think that's how the problem sorts itself out. Listen, I grew up in the business. And when I was a youngster, and I'm not trying to say it's completely better now, but I would describe remote locations as probably not friendly places for most young women. There were some women who grew up in the rackets, particularly if they had relatives present in the mine, who were shielded from some of the worst of those activities. And I'm not trying to say that the problem is over. I'm trying to say it's very, very, very different than it used to be. And I think that managements will change not merely because of ESG considerations, but simply out of need. The industry has too many challenges in front of it to ignore the intellectual contributions of half of humankind. That makes me sound very woke, maybe for the first time in my career. The second thing that you're seeing is that maybe 2 decades of gradual, I hate to use the phrase, integration means that increasingly more aspects of the mining business are being run by women, African people, Latin people, Native people. The truth is, and this is a very good thing, there's a whole broad range of perspectives. The idea that we had in the 1970s that all of the contributions that humankind had to offer mining were going to come from 4% of the population, which is to say old, bald, fat white guys, you know, probably ignored the math of humankind.
All right, Rick, I am going to close out today's conversation sort of where we started. We started our topic today on precious metals, but now I want to talk about the other precious metal. The precious metal either nobody takes seriously or takes too seriously. There seems to only be two camps on this one. I am going to talk about silver. Now,
Yep.
there was the silver squeeze of 2021 that really didn't happen. There's a little bit of, people not understanding how hard it is to push a $1 trillion market around.
Right.
Nearly spilt my coffee. So what you've got coming up, I want to talk a little bit about this because on February 11th, so a month from today, incidentally,
Yep.
you will be hosting a silver boot camp. Now, tell me, given the abundance of misinformation available on silver on the internet, what is this silver boot camp going to teach people?
I do boot camps, Shay, when I think a commodity is both due for a rebound and is unpopular. You'll recall the uranium boot camp, which
Yes.
I did last year. Another metal where there was substantial misinformation available to investors. Those people who were buying uranium, like those people who were buying silver, were often doing it for the wrong reasons. They had information around the market which was causing them to make a mistake. Make no mistake yourself. When something is out of favor, it's cheap. And the time to buy something is when it's cheap. If you look back at silver over time, a few things stand out. The first is that silver moves in the second half of precious metals bull markets. And I think that we're coming into the second half of a precious metals bull market. In precious metals bull market, the fear buyer comes first, and the fear buyer goes to gold. But when the momentum is established by gold, the more volatile metal, the poor man's gold, silver, takes over leadership, moves further and moves faster. The very fact that silver is out of favor coming into what I believe is the second half of a precious metals bull market is really intriguing to me. The most volatile of all asset classes that I know in commodities are reasonable quality silver equities. There just aren't very many of them. And when the metal itself delivers momentum and the generalist investor's money tries to squeeze itself into the silver equities, there isn't enough market cap to hold the money. I've seen it happen twice before. Our mutual friend Doug Casey describes the result as trying to siphon Hoover Dam, a big American lake, through a garden hose. It doesn't work. It's just an awful lot of fun. Now, there are probably 100 purported junior silver miners worldwide, most of which only have silver as a name on the share certificate. That is to say, they're silver miners, except they have no silver. One might reasonably expect them to underperform in a good market. There are, however, 15 or 20 speculative candidates that I think will do extraordinarily well. And when I look back over my own career, I look back really to the early days of my career, watching Coeur d'Alene mines go from, this is not a typo, 10 cents to $60. It's a big number. I remember being involved in the recapitalization financing for Silver Standard at 72 cents with $1.25 warrant, and seeing it go in 7 years to $45. I remember leading the first financing of Pan American Silver at 50 cents and seeing it go to $42. So the reason I'm doing the Silver Summit is, while I don't expect actually moves in that order of magnitude this time around, I think that 5-baggers and 10-baggers involving reasonably good companies could be fairly commonplace. And I like the fact that I get access to all of that upside in a sector where there's almost no competition, where there's no investor favor. I like, too, I guess because of the fact that I'm pushing 70 years old, that I've seen this happen 3 times before in my career. I might make some new mistakes this time, Shay. That's always possible. But I've made the old mistakes, and I've learned through things like the Uranium Summit, the Uranium Boot Camp, how to help investors, if they pay attention, avoid the worst mistakes that they might otherwise make. So I'm really attracted to it. We're going to have some of the most successful silver entrepreneurs over the last 50 years, Ross Beatty, Bob Quartermain, talk about how you build multi-billion-dollar silver companies, talk about how their experiences can help investors understand the do's and don'ts of silver. We're going to have an overview of the silver industry, the same way that we had an overview of the uranium industry in the Uranium Investors Boot Camp. We're going to talk about how to own physical silver. We're going to talk about how to own certificated silver. We're going to talk about the do's and don'ts of silver ETFs, but mostly we're going to talk about the silver equities. And that's an easy thing to do because the number of good ones relative to the total number of entrants is very low. So we'll be able to use real world examples. We will have exhibitors. And Shay, exhibitors, as you know, at my conference, every one of them are owned by me or by accounts that I manage. Now, that doesn't guarantee that, sadly, every stock I ever bought goes up. What it does guarantee is that I know the companies that will exhibit with me well enough that I have invested in them personally. At most conferences, the qualification to be an exhibitor is a check that cashes. My standards are somewhat more rigorous.
So, just to add a qualifier to this, one of my rules to investing when it comes to being an ordinary retail investor is follow what big money does. Now, I don't know what your bank balance, Rick, is, but I do know that you have decades of experience in this sector. So, if you have personally invested in these companies, it is somewhat of a qualifier for the average retail investor.
Understanding that my time frames are a little longer, and I'm willing to be much more aggressive.
Of
But
course.
I think for investors who understand that the payoff might not occur in 12 months, I mean, it might occur in a week, but it might not occur in 12 months. What really intrigues me about the silver business, Shay, what intrigued me about uranium was the certainty. What intrigues me about the silver business is the upside I personally have experienced and the lack of favor that silver finds itself in, the lack of competition to get involved in these companies relative to the upside, and also the propensity of silver investors to invest in narrative rather than arithmetic, which is to say the small amount of money that comes into the silver sector goes to the stories. It doesn't actually go to the viable silver companies, which is, aside from the fact that I'm sorry for the victims, hugely amusing to me personally.
I'm going to quote you on that. I love that. Now, Rick, you have been extraordinarily generous with your time today. I thank you so much for today's interview. It's been a lot of fun. Now, for anybody who does want to attend the Silver Summit or the Silver Boot Camp coming up on February 11th, there will be a link in the description of today's chat. So you can click on that and you can go through and you won't want to miss out on it because it is very important, as Rick says, to invest on arithmetic over narrative. Rick, I want to thank you so much for being here today. Again, you've been great. I love today's chat, and I hope to speak with you soon.
I hope so, Shay, and I hope you come and visit us in Florida again. It was fun hosting you at our live conference and taking you out on the boat cruise.
Yes, actually, I was looking at flights last night, and I can tell you I left with a very sore head the day after that cruise. there was some regret. All right, Rick, thanks again for being here. We'll speak soon.
Thank you.